With Chapter 4, we'll look more closely at risk and return, but we're really continuing concepts we covered in 331. Learning objectives for the chapter. We'll start by reviewing the concept of return and take a look at historical returns, time value of money, and how it relates to return. And we'll review TVM in Chapter 4A. Various measures of return, risk-free, required, and holding period. Internal rate of return, what it is, how to calculate it. Sources of risk that might affect potential investments, and the risk of a single asset. We're going to look more closely at the concept of return, its components, and the historical data. Return has two components: income, cash. From stock, this would be dividends. From bonds, periodic interest payments. From rental property, that could be rent. Capital gains is price appreciation. From all assets, it's the difference between the price you pay to buy it and the price you sell it for. Total return is just the sum of those two. This slide gives background data on two stocks, Target and Discover. We'll see the return results on the next slide. Note, their starting price is about the same, but their ending price goes quite a different direction. Though Target has more cash income, that's overcome by the capital loss, the steep decline in price. So the end result, Target lost $5.06, Discover gained $5.49. Return is important because it reflects how fast your investment dollars will grow. There's two views of return, historical and expected. Historical returns are readily available today online and in a form to be downloaded for analysis. Historical data does not provide a basis for future expectations. There's no guarantee. Expected return is what an investor thinks will happen in the future. Expectations determine what an investor is willing to pay for an asset, and this depends on the investor's personal expectations for the performance of the asset. This table recaps the historical performance for ExxonMobil from 2008 to 2017. Dividends, beginning and ending of year prices, and capital gain and total return. Also shown are average dividends per year, capital gains, and total returns. Notice that the dividend grows each year. Investors like that. Stock price performance has not been as positive, so the average capital gains are negative, resulting in an average return over the 10 years of 2.5%. Return on an individual asset can be driven by a variety of internal and external forces. Internal characteristics: the type of investment, is it a stock or a bond? The quality of the firm's management, the capital structure, how much debt and equity. External: the overall environment of the country, political, economic, and the industry the firm's in. The general direction of prices, are we in an inflation environment? Historical returns can tell you a lot about the general performance of an asset class. Average returns will be different for stocks, bonds, etc. in different countries, and we'll see it on the next slide. This table recaps average returns on stocks, long-term government bonds, short-term government bonds, and the inflation rate from 1900 to 2017 in a variety of countries. Highest return on stocks, South Africa. Long-term government bonds, Spain. Short-term government bonds, Finland. Inflation, Italy. Overall averages are shown at the bottom, and the United States is close to the world averages, with better returns on stocks. Time value of money. This should be very familiar to all of you. We're going to look at it relative to returns here, and then review it in the appendix to this chapter. Basic TVM rules. More money is better. Getting it sooner is better. Less risky is better. And we'll look at both calculator and Excel solutions. Time value of money and determining a satisfactory investment. The basics. If the present value of the benefits is equal to the cost, it's satisfactory. If it's greater than the cost, then the benefits exceed the cost, the investment is more than satisfactory. It's good. If it's less, it's not a good investment. Pretty straightforward. This is basically the NPV criteria stated in investment terms. NPV greater than 0, okay. Less than 0, not okay. This slide details a basic present value calculation for a cash flow stream. Very similar to Chapter 5 in Finance 331. In this case, again, the cash flow 0 is 0. This is set up to require an 8% return. If the investment would cost you more than $1175.85, then it's a no-go. Less than that, it's a good option. There are several measures of return that enable comparison between alternative investment options. Real return, expected return, required return, remember CAPM, holding period return, HPR, internal rate of return, IRR, finding the growth rate. Looking first at real, risk-free, and required returns. The nominal rate of return is expressed in current dollars. It does not consider the effect of inflation on purchasing power. The real rate of return measures the increase or decrease in purchasing power. It's approximately equal to the nominal return minus the inflation rate. We've said before, investors in general are risk-averse, meaning we require a higher return, a risk premium to take on more risk. Required return is the rate of return that compensates the investor for the risk involved. Think CAPM. Equations 4.1 and 4.1a reflect this situation. Required return is equal to the real return, the risk-free rate, plus the expected inflation premium, plus a risk premium. The nominal risk-free rate is a riskless rate that we can observe, such as the return on a treasury bill or a treasury bond. The real risk-free rate is unobservable. The expected inflation premium is exactly what it says, what we expect inflation to be over the investment's life. These equations reflect that. There's your expected inflation premium. The nominal risk-free rate is the real rate plus the expected inflation premium. Investors can always invest in a risk-free treasury security and earn the nominal risk-free rate. To entice an investor to take on a riskier investment, they must be offered a higher return, including a risk premium to compensate for added risk. The size of the risk premium will depend on a number of factors: the type of asset, the maturity, the firm and industry of the issuer. These equations, 4.3 and 4.3a, reflect that. The required return is the risk-free rate plus the risk premium for that asset. Holding period return. It's simply the time over which you wish to measure a return. Could be a day, a month, a year, several years. Frequently, we annualize returns for comparison with other investment options, but holding period can be any time period. The components of return: realized return, the actual return received from the sale of an asset. Paper return is the gain or loss not yet actually realized. It's based on purchase price and current market price. No sale has occurred. Putting holding period return into formulas. Equations 4.4, 4.4a, 4.5, and 4.5a. Holding period return is the income plus the capital gains divided by the beginning value. Capital gains is simply the ending price minus the beginning price. Using holding period return in investment decisions, it's a relative comparison. Here we have 4 investments: a savings account, common stock, a bond, and real estate. The table details quarterly income for each, along with ending and beginning values for a year. The result, holding period returns for each. No surprise, common stock has the highest return. Remember internal rate of return from 331? That's what we're talking about here. We're just implying it to an investment income stream. IRR is the discount rate that equates the present value of the cash flows to the purchase price. Putting this in a financial calculator, not exactly our usual TI, but it works the same. We're looking at the internal rate of return, in this case, for a single cash flow. Investments such as savings bonds, stocks that pay no dividend, zero coupon. Here's our example. What's the yield, IRR, on an investment costing $1,000 today that you expect will be worth $1,400 at the end of a 5-year holding period? Remember the sign convention. Income to you is positive, so the $1,400 is positive. Outflows from you are negative, so the $1,000 is an outflow. The present value is negative. Payment, 0. They don't show it, but it's 0. Compute IY. IRR is 6.96. We can use the rate function in Excel to find the same answer. And don't forget, in Excel, rates are decimals, whole numbers in the calculator. This table compares the present value of a cash flow stream discounted at 9% and 10%. There's our cash flow stream. There it is at 9%. There it is at 10%. You're all familiar with present value. You already know the outcome. The present value at 10% is less than at 9%. Looking at IRR in Excel, fortunately, Excel has an IRR function. Just give it the range and you get the internal rate of return. Remember, CF0 is negative because it's an outflow. You cannot find an IRR unless you have both positive and negative numbers. Okay, how about finding a growth rate? Finding a compound growth rate only requires the first and last values. In this case, we're looking at ExxonMobil's dividend. In 2008, it was $1.55. In 2017, it was $3.06. We want to find the rate that would grow $1.55 to $3.06 over 9 years. We found it, 7.852. Here you can see ExxonMobil's full dividend data again for the 9 years. Notice the format of the rate function. The number of periods is set to A12, 2017, minus A3, 2008, 9 years. This is an ordinary annuity. The type is 0. Okay, we've talked about return. Let's talk about risk, the other side of the coin. Risk is defined as uncertainty about the return an investment will generate. Obviously, a higher than expected return is great. Lower is not. We all know that there's a risk-return trade-off. To get higher returns, you'd have to take on more risk. Conversely, higher risk should be compensated. And we're going to look at the sources, risk of a single asset, and decision process. Various sources of risk. Business risk. This is related to the type of industry a firm is in. Varies based on the competency of a firm's management, the cost, and other firm-specific factors. Financial risk is the additional risk when a firm uses debt. More debt, more financial risk. Purchasing power risk. The possibility that changes in price levels could impact returns. Interest rate risk. This focuses more on bonds, whose value moves inversely with interest rates. Remember, the value of a bond is the present value of its cash flow stream, discounted at the current market rate. Higher rate, lower value. But interest rates really affect all securities. The risk-free rate is the intercept in CAPM. Liquidity risk. The risk you won't be able to sell an asset quickly without loss of value. Tax risk. Congress can change the tax laws, and they do all the time, in a way that adversely affects your investment returns. How about event risk? An unexpected event can have a significant and quick impact on an investment. And market risk. This is the same market risk we talked about in 331. It's the risk of being in the market versus investing in a risk-free asset. T-bills, treasury bonds. Market risk can cover economic, political, even social events that impact the market. It also can include purchasing power, interest rate, and tax risk. The risk of a single asset is measured by the standard deviation of its returns. Recall, again, from 331, we use standard deviation because it's measured as a percentage, whereas variance, which measures the same thing, is presented as percent squared. Not very intuitive. Look at equation 4.7 on the slide. This is the formula for the standard deviation of a range of historical data, not expectational. In 331, we worked with expectational. There was a probability factor. With historical data, we find the average return over the range and use it to compute and square deviations. The main difference? Before taking the square root, you divide by the number of observations minus 1. And we'll see the calculations on coming slides. Table 4.8 gives us 10 years of return data for Target and American Eagle Outfitters. The average return for each is already computed at the bottom of each column. The slide details the calculations for Target. First, there's Target's data. We found the average on the previous slide, 7.2%. We compute the deviation, the return in each year minus the overall average return. Square the deviations. Sum the squared deviations and divide by n minus 1, 9. Take the square root to find the standard deviation, 21.3. There's the formula. Remember, order of operations, PEMDAS. Here are the calculations for Target in Excel. And if you want to see them in Excel, click on the Excel logo there at the bottom. This slide repeats the calculations for American Eagle Outfitters. Again, the Excel symbol will take you to the computations in Excel. Now look at the difference. American Eagle Outfitters, standard deviation 38.8, Target 21.3. Bottom line, historical data can help you assess a pattern in risk and return of an investment. Higher risk should provide a higher return. Table 410 recaps average returns and standard deviations for stocks, long-term and short-term government bonds from many countries. There's the United States down at the bottom. Stocks, highest return is Finland at 16.4. Highest risk is Germany at 33.1. Long-term government bonds, highest return is Spain at 8%. Risk, Japan, 14%. Short-term government bonds, highest return is Finland, 6.5. Highest risk, Germany, 9.4. These graphs in Figure 4.1 graph the average returns in this order: short-term government bonds, long-term government bonds, and stocks. In other words, in order of ascending risk. So all the graphs are upward sloping lines, some more than others, but all have the same pattern. Okay, we pretty well covered return and the risk-return trade-off. You want higher returns. You'll have to take on more risk. An investment is riskier. It should provide a higher return. In general, low-risk, low-return investments include U.S. government securities and deposit accounts. High-risk, high-return investments include real estate, common stock, options, and futures, most of which we'll look at in coming chapters. This just puts investment alternatives on a slide scale from low risk to high risk on the x-axis, low return to higher return on the y-axis. No surprise, government securities are at the far left end, futures are at the top right. As we've mentioned, investors generally tend to be risk averse, but there are other approaches to risk. Risk neutral. A risk neutral investor doesn't require a risk premium to compensate them for higher risk. You don't see this very often. Risk averse, that's the baseline. A risk-averse investor requires a risk premium to take on greater risk. Risk-seeking. This investor seeks higher risk and will accept a lower return for the higher risk. You really don't see this very often. This chart graphically depicts the three risk positions we just described. Required return is on the y-axis, risk on the x-axis. Risk neutral is the straight blue line. The risk seeker accepts lower and lower returns in order to take on more risk, the downward sloping red line. The risk-averse investor, the rest of us, demands a higher and higher return in exchange for taking on more and more risk, the upward sloping green line. Last topic, using risk and return metrics to choose investments. Step 1, estimate the expected return. Either use historical data or project return data. Assess the risk of the investment. Use standard deviation of either historical or expected returns. Evaluate the risk-return characteristics from step 1 and 2. Is this return enough to compensate for the risk? Select the investments that offer the highest level of return for the risk you're willing to take on. And this ends Chapter 4.